Hi, it's Sir Rob. Today I am going to talk about the evolution of information system models. The development in information system models is inextricably linked to developments in information technology, particularly in computer hardware capabilities, which allow for more robust and more sophisticated computing implementations. In turn, the users clamor for functionalities that were then unavailable, drive the developments in computing hardware. Developments in software, on the other hand, depend on the user requirements and are limited by the capabilities that the hardware infrastructure imposes on software. Shown on the slide are operators working on the computer, Colossus. The Colossus was the first electronic programmable computer developed by Tommy Flowers and was first demonstrated in December 1943. The Colossus was created to help the British code breakers read encrypted German messages during World War II. Topics. In this presentation, we will look at the different models arranged in an evolution timeline. In each of the evolution state, we will discuss the defining feature or characteristic of the information system, the advantages and/or disadvantages, and how they relate to the developments in information technology and computers. The first, of course, is the manual or traditional model, which evidently was adopted first by the French, particularly the partnership of Giovanni Ferralfi and Company, a merchant partnership based in Nimes, France. Then, we will discuss the flat file or legacy model, characterized by the absence of structures for indexing or recognizing relationships between records. And then the relational database, which is the antithesis of the flat file model. The REA or resources, events, and agents conceptual accounting model and the enterprise resource planning model combine to deliver solutions to integrated management of mission-critical business processes, often in real time. Then, we will look at an example of the present-day implementation of the REA/ERP model. And finally, we will look at the role of the accountant related to information systems, such as the AIS. In the 21st century, early accounting information systems were designed for payroll functions in the 1970s. Presently, AIS are designed to support all accounting functions and activities, including auditing, financial accounting and reporting, managerial/management accounting and tax. The most widely adopted accounting information systems are auditing and financial reporting modules. Today, accounting information systems are more commonly sold as pre-built software packages from large vendors such as Microsoft, Sage Group, SAP AG SAP, and Oracle Corporation/Oracle, where it is configured and customized to match the organization's business processes. Small businesses often use accounting lower-cost spreadsheets, such as MS Excel. Software packages, such as MYOB and QuickBooks, are also purchased by small and medium-sized companies for the extra control over data. Large organizations would often choose enterprise resource planning or ERP systems. Today, cloud-based accounting information systems are increasingly popular for both SMEs and large organizations for lower costs. With adoption of accounting information systems, many businesses have removed low skills, transactional and operational accounting roles. The information system evolution timeline. The timeline is drawn with an arrow indicating evolution. The timeline arrow is also inclined upward, indicating general improvements in functionalities or capabilities of the information system. The arrowhead indicates that there are still unknown technology inventions in the future that will disrupt the present. The years indicated here are not to be understood as the inception of the evolution, but the general period when such evolution has attained general acceptance and has been assimilated into business applications. It must also be noted that each of these evolution stages are still in use as of present, and the hardware and software technology that supports them still exists, and are operational in many organizations, including the National Aeronautical Space Administration, or NASA.
The manual or traditional model. This early model of information system is synonymous to what you are learning in the classrooms today, recording transactions manually in physical journal and ledgers, performing month-end tasks using a multiple-column worksheet from which the financial statements take the data. And then you also manually prepare the formal financial statements from the worksheet. This model is already 8 centuries old. As early as the 13th century, evidences of business bookkeeping, reinforced by the invention of the double-entry system that evolved over time, and religiously adapted by Amitino Manichi. Manichi gave us the earliest extant record of accounting using the double-entry system. He kept the accounts for Giovanni Farolfi and Company, a merchant partnership based in Nimes, France. Manichi was a partner for the Salon, France branch. The writing, entirely in Manichi's hand, is neat, legible, and mostly well preserved. Financial records from 1299 to 1300 survive, that he kept for the firm's branch in Salon, Provence. Although these records are incomplete, they show enough detail to be identified as double-entry bookkeeping. These details include the use of debits and credits, and duality of entries. No more is known of Amitino Manichi than this ledger that he kept. Manichi didn't invent the double-entry system. That was a 100-year process, perhaps a 9,000-year process. If he didn't finish the process himself, it didn't occur long before, because it was clearly finished by the time he kept the books for his company. Later, in 1494, an Italian mathematician, Franciscan friar, Luca Pacioli, whose portrait appears on the slide, described the double-entry system in his book, Summa de Arithmetica, Geometria, Proportioni et Proportionalita, or, in short, Summa de Arithmetica, published in Venice in 1494. It was a textbook for use in the schools of northern Italy. With regards to this book, FoxBusiness.com published an article entitled, Luca Pacioli's 1494 book on business accounting could fetch $1.5 million at auction. Although Pacioli was not the first to publish a book describing the manual method, he was second to Benedetto Cotrugli. He was referred to as the father of accounting and bookkeeping in Europe. If you want to know more about the contributions of Manichi and Pacioli, you can watch an excerpt of a lecture video I downloaded from the website of Gresham College, from the link listed on the last slide of this presentation. I trimmed the video to show only the relevant lecture, and uploaded it to my Google channel, the link to which you can find in the module. Other extant documents from the 13th century include 1 bank ledger fragments from 1211 in Florence, France. 2 ledgers of Rini Ruffini and Brothers, 1296 to 1305. 3 ledger of Giovanni Farolfi and Company, 1299 to 1300. The Industrial Revolution. The Industrial Revolution was the transition to new manufacturing processes in Europe and the United States in the period from about 1760 to sometime between 1820 and 1840. This transition included going from hand production methods to machines, new chemical manufacturing, and iron production processes, the increasing use of steam power and water power, the development of machine tools, and the rise of the mechanized factory system. The Industrial Revolution marks a major turning point in history. Almost every aspect of daily life was influenced in some way. In particular, average income and population began to exhibit unprecedented sustained growth, Some economists have said the most important effect of the Industrial Revolution was that the standard of living for the general population in the Western world began to increase consistently for the first time in history, although others have said that it did not begin to meaningfully improve until the late 19th and 20th centuries. While the revolution gave birth to the corporations, the managers, cost accounting, and auditing, there was no notable developments in how the businesses managed the explosion of data caused by the increase in the volume of business transactions, number of employees and workers, sales and service volumes, and the need to track the cost of production and service. Businesses were still recording the transactions in physical journals and ledgers, and are preparing financial statements, including the consolidated financial statements of corporations, manually. Since we have computers now, why are we still learning the manual systems in the classroom? There are 3 advantages in doing so. 1. Learning the manual system links classroom theories and the IT accounting courses. The knowledge you gained in the manual system enables you, students, to understand the concepts in the IT courses, including AIS. 2. It enables the students to understand the IT black box. This indicates that whatever happens inside of a computer when you click a button will not be a mystery anymore. Students can relate the computer tasks with the manual tasks they were accustomed to. For example, when you click a button, say Prepare FS, and the output is displayed on the monitor or printed on paper, the student knows the inputs to the process and the manipulations the computer performed over the input to come out with the output. 3. It enables better business process design. Accountancy students are exposed to business cycle transactions and various internal controls implemented to ensure the integrity of information in the journal, protection of the actual assets, and the conformity of the financial statements to financial reporting standards. Where controls are inadequate, the accountant can be counted on to assess the design and recommend improvements to it.
The flat file or legacy model. The second stage in the evolution of information systems is the adoption of the flat file model. This approach is most often associated with so-called legacy systems, which are large mainframe systems, such as the IBM 701 and IBM System 360s, implemented in the late 1960s through the 1980s. In the 1990s, I saw one of these IBM monoliths in my work in Philamp Plans Incorporated. It occupied half of the 6th floor of our office building. Organizations today still use these systems extensively, and accountants must continue to deal with legacy system technologies. This model describes an environment in which individual files are not related to other files, and users own their data files, rather than share them with other users. When multiple users need the same data for different purposes, they must obtain separate data sets structured to their specific need. Thus, standalone applications, rather than integrated systems, perform data processing separate from each other. Strictly speaking, a list of names, addresses, and phone numbers written by hand on a sheet of paper is a flat file database. This can also be done with any typewriter or word processor. A spreadsheet or text editor program may be used to implement a flat file database, which may then be printed or used online for improved search capabilities. In Excel, a workbook with a single sheet is a flat file. In Word, a table with data is also a flat file. The figure on the slide illustrates how customer sales data might be presented to different users of a service company. The accounting function needs customer sales data organized by account number and structured to show outstanding balances. This is used for customer billing, AR maintenance, and financial statement preparation. Marketing needs customer sales history data, organized by demographic keys. They use this for targeting new product promotions and for selling product upgrades. The product services group need customer sales data organized by products and structured to show scheduled service dates. Such information is used for making after-sales contacts with customers, to schedule preventive maintenance, and to solicit sales of service agreements. The customer care also needs the customer data for accessing history of call-ins and call-outs, for customer inquiries and complaints. The data redundancy demonstrated in this example contributes to 3 significant problems in the flat file environment. Problems with the flat file model. The obvious problems stemming from the flat file model's data redundancy are: 1. Data storage. Because the databases are not related to, nor shared with each other, each department keeps their own database. In contrast, an efficient information system captures and stores data only once, and makes the source available to all users who need it. In this model, this is not possible. To meet the private data needs of users, organization must incur the costs of both multiple collection and multiple storage procedures. Some commonly used data may be duplicated dozens, hundreds, or even thousands of times. 2. Data updating. Organizations have a great deal of data stored in files that require periodic updating to reflect changes. For example, a change to a customer's name or address must be reflected in the appropriate master files. When users keep separate files, all changes must be made separately, for each group of users. This adds significantly to the task and the cost of data management. 3. Currency of information. In contrast to the problem of performing multiple updates, is the problem of failing to update all the user files affected by a change in status. If update information is not properly disseminated, the change will not be reflected in some users' data, resulting in decisions based on outdated information. 4. Task data dependency. Users' inability to obtain additional information, as his or needs change, is a big challenge. The user's information set is constrained by the data that he or she possesses and controls. Users act independently, rather than as members of a user community. In such environment, it is very difficult to establish a mechanism for the formal sharing of data. Therefore, new information needs tend to be satisfied by procuring new data files. This takes time, inhibits performance, adds to data redundancy, and drives data management costs even higher. 5. Flat files limit data integration. The flat file approach is a single view model. Files are structured, formatted, and arranged to suit the specific needs of the owner, or primary user of the data. Such structuring, however, may exclude data attributes that are useful to other users, thus preventing successful integration of data across the organization. For example, because the accounting function is the primary user of accounting data, these data are often captured, formatted, and stored to accommodate financial reporting and generally accepted accounting principles, or GAAP. This structure, however, may be useless to the organization's other, non-accounting, users of accounting data, such as the marketing, finance, production, and engineering functions. These users are presented with 3 options. 1. Do not use accounting data to support decisions. 2. Manipulate and massage the existing data structure to suit their unique needs. And 3. Obtain additional private sets of the data and incur the costs and operational problems associated with data redundancy. The flat file era was uncontestably dominated by the tech company International Business Machines, or IBM. IBM, nicknamed Big Blue, is an American multinational technology company headquartered in Armonk, New York. with operations in over 170 countries. The company began in 1911, founded in Endicott, New York, as the Computing Tabulating Recording Company, CTR, and was renamed International Business Machines in 1924. By 1937, IBM was still using the tabulating equipment, using punch cards as input and data storage medium. The punch card may be considered the first computerized flat file database, as it, presumably, included no cards indexing other cards, or otherwise relating the individual records, that is the individual cards, to one another. The punch card technology enabled organizations to process huge amounts of data. IBM's clients included the U.S. government, during its first effort to maintain the employment records for 26 million people, pursuant to the Social Security Act, and Hitler's Third Reich, for the tracking of Jews and other persecuted groups, largely through the German subsidiary, Die Homig. The Social Security-related business gave an 81% increase in revenue from 1935 to 1939. By the 1940s, IBM had no computers, they were only selling business machines and data management services, using the punch card technology. Led by its first president, Thomas Watson Sr., IBM was not eager to jump into the enormously costly development of computers until the company was threatened into it by its customers who were fed up by bulky punch cards. They threatened to cancel their IBM contracts just as soon as they learned how to do data management using magnetic tapes, because their IBM data in punch cards, which stores the customer account's data, were occupying whole floors in their buildings. So in 1952, IBM announced to the public its first commercial scientific computer and its first series production mainframe computer, the IBM 7L1 electronic data processing machine. It was responsible for bringing electronic computing to the world, and for IBM's dominance in the mainframe computer market during the 1960s and 1970s, that continues today. The series were IBM's high-end computers, until the arrival of the IBM System 360 in 1964. These machines are now referred to as part of the legacy systems. In computing, a legacy system refers to an old method, technology, computer system, or application program of relating to, or being a previous or outdated computer system, yet still in use. Often, referencing a system as legacy means that it paved the way for the standards that would follow it. This can also imply that the system is out of date or in need of replacement. The first use of the term legacy to describe computer systems probably occurred in the 1970s, when the relational database proposed by Edgar Frank Codd started to saturate the computer market. By the 1980s, it was commonly used to refer to existing computer systems, to distinguish them from the design and implementation of new systems. Legacy was often heard during a conversion process, for example, when moving data from the legacy system to a new database. Slide 12. In spite of these inherent limitations, many large organizations still use the flat files for their general ledger and other financial systems. Most members of the data processing community assumed that the end of the century would see the end of legacy systems. Instead, corporate America invested billions of dollars making these systems year 2000, Y2K, compliant. Legacy systems continue to exist because they add value for their users, and they will not be replaced until they cease to add value. Students who may have to work with these systems in practice should be aware of their key features. While legacy is a term that may indicate that some engineers may feel that a system is out of date, a legacy system can continue to be used for a variety of reasons. It may simply be that the system still provides for the user's needs. As can be seen on the slide, MS-DOS was still used to run legacy applications in a US Navy service department. Another example is an ATM being ran by a Windows XP operating system software. In addition, the decision to keep an old system may be influenced by economic reasons, such as return on investment challenges or vendor login, the inherent challenges of change management, or a variety of other reasons other than functionality. Organizations can have other compelling reasons for keeping a legacy system, such as retraining on a new system would be costly in lost time and money, compared to the anticipated appreciable benefits of replacing it, which may be zero. The system requires near constant availability, so it cannot be taken out of service, and the cost of designing a new system with a similar availability level is high. Examples include systems to handle customers' accounts in banks, computer reservation systems, air traffic control, energy distribution, power grids, nuclear power plants, and military defense installations. The way that the system works is not well understood. Such a situation can occur when the designers of the system have left the organization, and the system has either not been fully documented, or documentation has been lost. The user expects that the system can easily be replaced when this becomes necessary. Newer systems perform undesirable, especially for individual or non-institutional users, secondary functions such as a. Tracking and reporting of user activity and/or b. Automatic updating that creates backdoor security vulnerabilities and leaves end users dependent on the good faith and honesty of the vendor providing the updates. This problem is especially acute when the secondary functions of a newer system cannot be disabled. Backward compatibility, such as the ability of newer systems to handle legacy file formats and character encodings, is a goal that software developers often include in their work. For a more recent and updated study on the present use of legacy systems, you may read the article entitled, "Legacy Systems Continue to Have a Place in the Enterprise," at computerweekly.com. Software-related problems with the flat file model. Flat files associated with legacy systems are also considered to be potentially problematic by software engineers for several reasons. 1. If legacy software runs on only antiquated hardware, the cost of maintaining the system may eventually outweigh the cost of replacing both the software and hardware, unless some form of emulation or backward compatibility allows the software to run on new hardwares. 2. These systems can be hard to maintain, improve, and expand because there is a general lack of understanding of the system. The staff who were experts on it have retired or forgotten what they knew about it, and staff who entered the field after it became legacy never learned about it in the first place. This can be worsened by lack or loss of documentation. Clamor Airline Company fired its CEO in 2004 due to the failure of an antiquated legacy crew scheduling system that ran into a limitation not known to anyone in the company. 3. Legacy systems may have vulnerabilities in older operating systems or applications due to lack of security patches being available or applied. There can also be production configurations that cause security problems. These issues can put the legacy system at risk of being compromised by attackers or knowledgeable insiders. 4. Integration with newer systems may also be difficult because new software may use completely different technologies. Integration across technology is quite common in computing, but integration between newer technologies and substantially older ones is not common. There may simply not be sufficient demand for integration technology to be developed. Some of this glue code is occasionally developed by vendors and enthusiasts of particular legacy technologies. 5. Budgetary constraints often lead corporations to not address the need of replacement or migration of legacy system. However, companies often don't consider the increasing supportability costs, people, software, and hardware, all mentioned above, and do not take into consideration the enormous loss of capability or business continuity if the legacy system were to fail. Once these considerations are well understood, then based on the proven ROI of a new, more secure, updated technology stack platform is not as costly as the alternative, and the budget is found. 6. Due to the fact that most legacy programmers are entering retirement age, and the number of young engineers replacing them is very small, there is an alarming shortage of available workforce. This in turn results in difficulty in maintaining legacy systems, as well as an increase in costs of procuring experienced programmers.
The relational database model. A relational database is a digital database based on the relational model of data, as proposed by E.F. Codd of IBM San Jose Research Laboratory in 1970. A software system used to maintain relational databases is a relational database management system, RDBMS. Many relational database systems have an option of using the SQL, structured query language, for querying and maintaining the database. The term relational database was invented by Codd. Codd introduced the term in his research paper, A Relational Model of Data for Large Shared Data Banks. In this paper and later papers, he defined what he meant by relational. One well-known definition of what constitutes a relational database system is composed of Codd's 12 rules. However, no commercial implementations of the relational model conform to all of Codd's rules, so the term has gradually come to describe a broader class of database systems, which at a minimum conforms to these two standards. 1. Present the data to the user as relations, a presentation in tabular form, that is as a collection of tables, with each table consisting of a set of rows and columns, and 2. Provide relational operators to manipulate the data in tabular form. The 5 leading proprietary software relational database vendors by revenue were Oracle, 48.8%, IBM, 20.2%, Microsoft, 17%, SAP including Sybase, 4.6%, and Teradata, 3.7%. The table on the slide summarizes some of the most important relational database terms and the corresponding SQL term. In 1974, IBM began developing System R, a research project to develop a prototype RDBMS. The first system sold as an RDBMS was Multics Relational Data Store, June 1976. Oracle was released in 1979 by Relational Software, now Oracle Corporation. Angra and IBM BS12 followed. Other examples of an RDBMS include DB2, SAP Sybase ASE, and Informix. In 1984, the first RDBMS for Macintosh began being developed, codenamed Silver Surfer. It was later released in 1987 as Fourth Dimension and known today as 4D. The most common definition of an RDBMS is a product that presents a view of data as a collection of rows and columns, even if it is not based strictly upon relational theory. By this definition, RDBMS products typically implement some, but not all of Codd's 12 rules. A relational database has become the predominant type of database. As of 2009, most commercial relational DBMSs employ SQL as their query language. Features of the relational database model. The problems associated with the flat file model is overcome by implementing the database model to data management. The figure on the slide illustrates how this approach centralizes the organization's data into a common database that is shared by multiple users from different functional groups. With the organization's data in a central location, all users have access to the data they need to achieve their respective operational objectives. Access to the data resources is controlled by a database management system, or DBMS, which we have discussed in Chapter 1. This additional element in the structure is programmable to know which data elements each user is authorized to access. If the user requests data that he or she is not authorized to access, the request is denied. Thus, in this model, the organization's procedure for assigning user authority are an important control issue for auditors to consider. The most striking difference between the database model and the flat file model is the pooling of data into a common database that all organizational users share. With access to the full domain of entity data, changes in user information needs can be satisfied without obtaining additional private data sets. Users are constrained only by the limitations of the data available to the entity and the legitimacy of their need to access it, the policy and parameters of which are integrated into the DBMS. Through data sharing, the following traditional problems associated with the flat file approach may be overcome. 1. Elimination of data redundancy. Each data element is stored only once, thereby eliminating data redundancy and reducing data collection and storage costs. For example, customer data exists only once, but is shared by accounting, marketing, and product services users. To accomplish this, the data are stored in generic format that supports multiple users. 2. Single update. Because each data element exists in only one place, it requires on a single update procedure. This reduces the time and cost of keeping the database current. 3. Current values. A single change to a database attribute, such as a change in status or address, is automatically made available to all users of the attribute, immediately reflected in the various user views. The Relational Database Model, or RDBMS, made true integration possible. This flexible database approach permits the design of integrated systems applications, capable of supporting the information needs of multiple users from a common set of integrated database tables. It should be noted, however, that RDBMS models merely permits integration to occur. Integration is not guaranteed. Poor systems design can occur under any model. In fact, most organizations today that employ RDBMSs run applications that are traditional in design and do not make full use of relational technology. The two remaining related models to be discussed, REA and ERP, employ relational database technology more effectively.
The REA model. Resources, Events, Agents, or REA, is a model of how an accounting system can be re-engineered for the computer age. REA was originally proposed in 1982 by William E. McCarthy as a generalized accounting framework, and contained the concepts of resources, events, and agents. Advances in database technology have focused renewed attention on REA as a practical alternative to the classic accounting framework. REA is a popular model in teaching accounting information systems, but it is rare in business practice. Most companies cannot easily dismantle their legacy data warehouse systems, or are unwilling to do so. Workday Incorporated, IBM Scalable Architecture for Financial Reporting, REA Technology, and ISO 15944-4 are exceptions. Fallon and Polovina have, however, shown how REA can also add value when modeling current ERP business processes, by providing a tool which increases the understanding of the implementation and underlying data model. Description of the model. The REA model gets rid of many accounting objects that are not necessary in the computer age. Most visible of these are debits and credits. double-entry bookkeeping disappears in an REA system. Many general ledger accounts also disappear, at least as persistent objects. For example, accounts receivable or accounts payable. The computer can generate these accounts in real time using source document records. REA treats the accounting system as a virtual representation of the actual business. In other words, it creates computer objects that directly represent real-world business objects. In computer science terms, REA is an ontology. The real objects included in the REA model are goods, services, or money, that is, resources. Business transactions or agreements that affect resources, that is, events. People or other human agencies, other companies, etc., that is, agents. These objects contrast with conventional accounting terms such as asset or liability, which are less directly tied to real-world objects. For example, a conventional accounting asset such as goodwill is not an REA resource. There is a separate REA model for each business process in the company. A business process roughly corresponds to a functional department or a function in Michael Porter's value chain. Examples of business processes would be sales, purchases, conversion or manufacturing, human resources, and financing. At the heart of each REA model, there is usually a pair of events linked by an exchange relationship, typically referred to as the duality relation. One of these events usually represents a resource being given away or lost, while the other represents a resource being received or gained. For example, in the sales process, one event would be sales where goods are given up and the other would be cash receipt, where cash is received. These two events are linked. A cash receipt occurs in exchange for a sale, and vice versa. The duality relationship can be more complex. For example, in the manufacturing process, it would often involve more than two events. REA systems have usually been modeled as relational databases with entity relationship diagrams, though this is not compulsory. REA is a continuing influence on the electronic commerce standard EBXML, with McCarthy actively involved in the standards committee. The competing XBRLGL standard, however, is at odds with the REA concept, as it closely mimics double-entry bookkeeping. REA is now recognized by the Open Group, OG, within the TOGAF standard, an industry standard enterprise framework, as one of the modeling tools which is useful for modeling business processes.
The ERP model. As the need for connectivity and consolidation between other business systems increased, accounting information systems were merged with larger, more centralized systems known as Enterprise Resource Planning, or ERP. Before, with separate applications to manage different business functions, organizations had to develop complex interfaces for the systems to communicate with each other. In ERP, a system such as Accounting Information System is built as a module integrated into a suite of applications that can include manufacturing, supply chain, human resources, and a lot more. These modules are integrated together and are able to access the same data and execute complex business processes. ERP is the integrated management of main, or core, business processes, often in real time and mediated by software and technology. It is usually referred to as a category of business management software, typically, a suite of integrated applications that an organization can use to collect, store, manage, and interpret data from many business activities. It provides an integrated and continuously updated view of core business processes, using common databases maintained by a database management system. ERP systems track business resources, cash, raw materials, production capacity, and the status of business commitments, such as orders, purchase orders, and payroll. The applications that make up the system share data across various departments: manufacturing, purchasing, sales, accounting, etc., that provide the data. It facilitates information flow between all business functions and manages connections to outside stakeholders. Enterprise systems software is a multi-billion-dollar industry that produces components supporting a variety of business functions. IT investments have, as of 2011, become one of the largest categories of capital expenditure in United States-based businesses. Though early ERP systems focused on large enterprises, smaller enterprises increasingly use ERP systems. The ERP system integrates varied organizational systems and facilitates error-free transactions and production, thereby enhancing the organization's efficiency. However, developing an ERP system differs from traditional system development. ERP systems run on a variety of computer hardware and network configurations, typically using a database as an information repository. Origin. The Gartner Group first used the acronym ERP in the 1990s to include the capabilities of Material Requirements Planning, MRP, and the later Manufacturing Resource Planning, MRP2, as well as Computer Integrated Manufacturing. Without replacing these terms, ERP came to represent a larger whole that reflected the evolution of application integration beyond manufacturing. Not all ERP packages are developed from a manufacturing core. ERP vendors variously began assembling their packages with finance and accounting, maintenance, and human resource components. By the mid-1990s, ERP systems addressed all core enterprise functions. Governments and nonprofit organizations also began to use ERP systems. Expansion. ERP systems experienced rapid growth in the 1990s. Because of the year 2000 problem, many companies took the opportunity to replace their old systems with ERP. ERP systems initially focused on automating back-office functions that did not directly affect customers and the public. Front-office functions, such as customer relationship management, CRM, dealt directly with customers, or e-business systems such as e-commerce, e-government, e-telecom, and e-finance. Supplier relationship management, SRM, became integrated later, when the Internet simplified communicating with external parties. ERP2 was coined in 2000 in an article by Gartner Publications entitled, "ERP is Dead. Long Live ERP2." It describes web-based software that provides real-time access to ERP systems to employees and partners, such as suppliers and customers. The ERP2 role expands traditional ERP resource optimization and transaction processing. Rather than just manage buying, selling, etc., ERP2 leverages information in the resources under its management to help the enterprise collaborate with other enterprises. ERP2 is more flexible than the first-generation ERP. Rather than confine ERP system capabilities within the organization, it goes beyond the corporate walls to interact with other systems. Enterprise Application Suite is an alternate name for such systems. ERP2 systems are typically used to enable collaborative initiatives, such as supply chain management, SCM, customer relationship management, CRM, and business intelligence, BI, among business partner organizations, through the use of various e-business technologies. Developers now make more effort to integrate mobile devices with the ERP system. ERP vendors are extending ERP to these devices, along with other business applications. Technical stakes of modern ERP concern integration, hardware, applications, networking, supply chains. ERP now covers more functions and roles, including decision-making, stakeholders relationships, standardization, transparency, globalization, etc. Characteristics. ERP systems typically include the following characteristics. An integrated system operates in or near real time. A common database that supports all the applications. A consistent look and feel across modules. Installation of the system with elaborate application/data integration by the IT department, provided the implementation is not done in small steps. Deployment options include on-premises, cloud-hosted, or software as a service or SaaS. Functional areas. An ERP system covers the following common functional areas. In many ERP systems, these are called and grouped together as ERP modules. Financial accounting, general ledger, fixed assets, payables including vouchering, matching and payment, receivables, and collections, cash management, financial consolidation, management accounting, budgeting, costing, cost management, activity-based costing, human resources, recruiting, training, rostering, payroll, benefits, retirement and pension plans, diversity management, retirement, separation, manufacturing, engineering, bill of materials, work orders, scheduling, capacity, workflow management, quality control, manufacturing process, manufacturing projects, manufacturing flow, product life cycle management, order processing, order to cash, order entry, credit checking, pricing, available to promise, inventory, shipping, sales analysis and reporting, sales commissioning, supply chain management, supply chain planning, supplier scheduling, product configurator, order to cash, purchasing, inventory, claim processing, warehousing, receiving, put away, picking and packing, project management, project planning, resource planning, project costing, work breakdown structure, billing, time and expense, performance units, activity management, customer relationship management, CRM sales and marketing, commissions, service, customer contact, call center support. CRM systems are not always considered part of ERP systems but rather business support systems, BSS. Data services, various self-service interfaces for customers, suppliers, and/or employees. Management of school and educational institutes. Best practices. Most ERP systems incorporate best practices. This means the software reflects the vendor's interpretation of the most effective way to perform each business process. Systems vary in how conveniently the customer can modify these practices. In addition, best practices reduced risk by 71% compared to other software implementations. Use of best practices eases compliance with requirements, such as IFRS, Sarbanes-Oxley, or Basel II. They can also help comply with de facto industry standards, such as electronic funds transfer. This is because the procedure can be readily codified within the ERP software and replicated with confidence across multiple businesses that share that business requirement. The following are some best practices in an ERP implementation. 1. Connectivity to plant floor information. ERP systems connect to real-time data and transaction data in a variety of ways. These systems are typically configured by systems integrators, who bring unique knowledge on process, equipment, and vendor solutions. 2. Direct integration. ERP systems have connectivity, communications to plant floor equipment, as part of their product offering. This requires that the vendors offer specific support for the plant floor equipment their customers operate. 3. Database integration. ERP systems connect to plant floor data sources through staging tables in a database. Plant floor systems deposit the necessary information into the database. The ERP system reads the information in the table. The benefit of staging is that ERP vendors do not need to master the complexities of equipment integration. Connectivity becomes the responsibility of the systems integrator. 4. Enterprise Appliance Transaction Modules, AATM. These devices communicate directly with plant floor equipment and with the ERP system via methods supported by the ERP system. AATM can employ a staging table, web services, or system-specific program interfaces, or APIs. An EATM offers the benefit of being an off-the-shelf solution. 5. Custom integration solutions. Many system integrators offer custom solutions. These systems tend to have the highest level of initial integration cost and can have a higher long-term maintenance and reliability costs. Long-term costs can be minimized through careful system testing and thorough documentation. Custom integrated solutions typically run on workstation or server-class computers. Business process management. Implementing ERP typically requires changes in existing business processes. Poor understanding of needed process changes prior to starting implementation is a main reason for project failure. The difficulties could be related to the system, business process, infrastructure, training, or lack of motivation. It is therefore crucial that organizations thoroughly analyze business processes before they deploy an ERP software. Analysis can identify opportunities for process modernization. It also enables an assessment of the alignment of current processes with those provided by the ERP system. Research indicates that risk of business process mismatch is decreased by linking current processes to the organization's strategy, analyzing the effectiveness of each process, understanding existing automated solutions. Advantages. 1. The most fundamental advantage of ERP is that the integration of a myriad of business processes saves time and expense. Management can make decisions faster and with fewer errors. Data becomes visible across the organization. Tasks that benefit from this integration include sales forecasting, which allows inventory optimization. Chronological history of every transaction through relevant data compilation in every area of operation. Order tracking, from acceptance through fulfillment. Revenue tracking, from invoice through cash receipt. Matching purchase orders, what was ordered, inventory receipts, what arrived, and costing, what the vendor invoiced. ERP systems centralize business data, which eliminates the need to synchronize changes between multiple systems, consolidation of finance, marketing, sales, human resource, and manufacturing applications. Brings legitimacy and transparency to each bit of statistical data. Facilitates standard product naming/coding. Provides a comprehensive enterprise view, no islands of information, making real-time information available to management anywhere, anytime to make proper decisions. Protects sensitive data by consolidating multiple security systems into a single structure. 2. ERP creates a more agile company that adapts better to change. It also makes a company more flexible and less rigidly structured, so organization components operate more cohesively, enhancing the business, internally and externally. 3. ERP can improve data security in a closed environment. A common control system, such as the kind offered by ERP systems, allows organizations the ability to more easily ensure key company data is not compromised. This changes, however, with a more open environment, requiring further scrutiny of ERP security features and internal company policies regarding security. 4. ERP provides increased opportunities for collaboration. Data takes many forms in the modern enterprise, including documents, files, forms, audio and video, and emails. Often, each data medium has its own mechanism for allowing collaboration. ERP provides a collaborative platform that lets employees spend more time collaborating on content, rather than mastering the learning curve of communicating in various formats across distributed systems. ERP offers many benefits such as standardization of common processes, one integrated system, standardized reporting, improved key performance indicators, or KPI, and access to common data. One of the key benefits of ERP, the concept of integrated system, is often misinterpreted by the business. ERP is a centralized system that provides tight integration with all major enterprise functions, be it HR, planning, procurement, sales, customer relations, finance or analytics, as well as to other connected application functions. In that sense, ERP could be described as Centralized Integrated Enterprise System, CIES. Disadvantages. 1. Customization can be problematic. Compared to the best-of-breed approach, ERP can be seen as meeting an organization's lowest common denominator needs, forcing the organization to find workarounds to meet unique demands. 2. Re-engineering business processes to fit the ERP system may damage competitiveness or divert focus from other critical activities. 3. ERP can cost more than less integrated or less comprehensive, but equally effective, solutions. 4. High ERP switching costs can increase the ERP vendor's negotiating power, which can increase support, maintenance, and upgrade expenses. 5. Overcoming resistance to sharing sensitive information between departments can divert management attention. 6. Integration of truly independent businesses can create unnecessary dependencies. 7. Extensive training requirements take resources from daily operations. 8. Harmonization of ERP systems can be a mammoth task, especially for big companies, and requires a lot of time, planning, and money. This slide presents an example of the implementation of the REA concept and ERP in the order processing business process, based on the business models of Lazada and Shopee. The resources that are affected in the order process are cash and inventory. A third resource which may be created may be called order, to enable the tracking of orders that has not yet been fulfilled. The events that affect this resources are listed under the events column. There are 8 events, trigger by the 5 agents, cause an addition or update to the databases. For example, when a customer makes an online order and checks out the item, the order and inventory resources gets updated, flagging the order as confirmed and the inventory item as reserved. When the courier delivers the item, the order is flagged as delivered and the inventory item as sold. And lastly, when the customer pays, the order resource is flagged as paid and the cash resource as received. These examples emphasize the duality of effect concepts, much like the debit and credit concepts in the traditional accounting framework.
How does the accountant fit? Our final topic in this chapter deals with the accountant's relationship to the information system. Accountants are primarily involved in 3 ways, as system users, designers, and auditors. As users, in most organizations, the accounting function is the single largest user of IT. All systems that process financial transactions impact the accounting function in some way. As end users, accountants must provide a clear picture of their needs to the professionals who design their systems. For example, the account must specify accounting rules and techniques to be used, internal control requirements, and special algorithms such as depreciation models. The accountant's participation in system development should be active rather than passive. The principal cause of design errors that result in system failure is the absence of their involvement. As system designers, an appreciation of the accountant's responsibility for system design requires a historic perspective that predates the computer as a business information tool. Traditionally, under the manual model, accountants have been responsible for key aspects of the information system, including assessing the information needs of users, defining the content and format of output reports, specifying sources of data, selecting the appropriate accounting rules, and determining the controls necessary to preserve the integrity and efficiency of the information system. These traditional systems were physical, observable, and unambiguous. The procedures for processing information were manual, and the medium for transmitting and storing data was paper. With the arrival of the computer, computer programs replaced manual procedures, and paper records were stored digitally. The role accountant would play in this new era became the subject of much controversy. Lacking computer skills, accountants were generally uncertain about their status and unwilling to explore this emerging technology. Many accountants relinquished their traditional responsibilities to the new generation of computer professionals who were emerging in their organizations. Computer programmers, often with no accounting or business training, assumed full responsibility for the design of AIS. As a result, many systems violated accounting principles and lacked necessary controls. Large system failures and computer frauds marked this period in accounting history. By the mid-1970s, in response to these problems, the accounting profession began to reassess the accountant's professional and legal responsibilities for computer-based information systems. Today, we recognize that the responsibility for system design is divided between accountants and IT professionals as follows. The accounting function is responsible for the conceptual system, and the IT function is responsible for the physical system. To illustrate the distinction between conceptual and physical systems, consider the following example. The credit department of a retail business requires information about delinquent accounts from the AR department. This information supports decisions made by the credit manager regarding the creditworthiness of customers. The design of the conceptual system involves specifying the criteria for identifying delinquent customers and the information that needs to be reported. The accountant determines the nature of the information required, its sources, its destination, and the accounting rules that need to be applied. The physical system is the medium and method for capturing and presenting the information. The computer professionals determine the most economical and effective technology for accomplishing the task. Hence, system design should be a collaborative effort. Because of the uniqueness of each system, and the susceptibility of systems to serious error and even fraud, the accountant's involvement in system design should be pervasive. As students of accounting, you are exposed early on to the processes of the different business cycles, and to the controls that should be integrated into the manual processes, better yet, into the automated systems. When you enter the workforce, you are already equipped with such competencies, and are already well qualified to be part of information system projects as system analysts, who design the systems to be programmed by software engineers. As information system auditors, auditing is a form of independent attestation performed by an expert, the auditor, who expresses an opinion about the fairness of a company's financial statement. This function requires that auditors also evaluate and test the company's internal controls, which may be manual or built into the information system. Public confidence in the reliability of internally produced financial statements rests directly on their being validated by an independent expert auditor. This service is often referred to as the attest function. Auditors form their opinion based on a systematic process, following a set of auditing standards. As auditors of the information systems that generate the financial statements, accountants are concerned about the general and application controls that are built into the system, which affect the general assertions of existence or occurrence, completeness, rights, and obligations, valuation or allocation, and presentation and disclosure. It should be noted that the audit procedures in an IAS audit, auditing through the computer, is significantly different from the traditional audit, which only employs auditing around the computer. In your fourth year level, you will actually learn how to audit information systems. There it is. The evolution of information system models, from the manual and traditional model to the 21st century IT-dependent models. Note that this discussion provides a framework for much of the subsequent topics. Listed on the slide are the references used in the production of this topic discussion video. Thank you and stay safe always.